So an obstacle every trader has to overcome is the ability to determine whether or not there is a change in momentum of a stock. Mastering this can be huge. For example, with a 2-to-1 risk to reward ratio, a trader could potentially grow their account by nearly 400% over the course of just 100 trades on a $1,000 trading account with only a 60% win rate. Which is why in a year that isn't important, a guy whose name doesn't matter invented a trading indicator that millions of traders have used since its inception in order to help them predict the most important part of trading: momentum. And that indicator is the MACD. Mastering the MACD can be a game changer if you can learn how to consistently use it correctly. And today we're going to tell you just how to do that. And after you've mastered the MACD, you can retire early or buy an island like Mr. Beast or whatever floats your boat. The indicator consists of 3 parts: a MACD line, a signal line, and a histogram. The MACD line is calculated by subtracting the 26-period EMA from the 12-period EMA and plotting it onto the indicator. The signal line is simply a 9-day EMA of the MACD line and is used as a buy and sell trigger. And then finally, the histogram represents the difference between the MACD and the signal line and is used to visualize the strength and direction of the momentum. A stronger separation of these lines results in a more pronounced histogram bars and helps determine the strength of the current momentum. So it's important to know that if the MACD line is below the signal line, the histogram will be below the MACD's baseline, which is often referred to as the zero line. If the MACD line is above the signal line, the histogram will be above the zero line. So the first very important thing to know when using the MACD to determine momentum of a stock is where the MACD line and signal line are in relation to the zero line. Again, this is very important, so pay attention. When the MACD line crosses above the zero line, the momentum is considered bullish. On the other hand, when the MACD line crosses below the zero line, the momentum is considered bearish. This is important because an inexperienced trader using the MACD can so easily ignore this key point because the zero line is often faded, dotted, or just plain thin. For some reason, it's often designed to look like an afterthought, and thus many inexperienced traders don't understand its importance when determining momentum. One thing a trader can do when learning the MACD is brightening up the zero line. Basically, simply, you can't ignore it if it's staring you right in the face. Also, consider paper trading by solely buying and selling based on when the MACD and signal line cross above and below the zero line. This will help you gain confidence in this key factor and show you just how important it is in determining a momentum of a stock. So you have your first key factor in determining momentum, but how do you know when to buy or sell? The signal line was designed to help you determine just that. So remember, the signal line is just a lazier version of the MACD line. And so a cross between the signal line and the MACD line indicates there is a potential change in momentum. So just go along whenever the MACD line crosses above the signal line and sell whenever the opposite occurs, right? Wrong. As previously stated, the momentum of a stock is also determined by where the MACD line and signal line are in relation to the faded afterthought zero line. While a trader could theoretically start nibbling on a trade by scaling into a small position whenever this occurs, it's important to note that you are still trading against a trend, and it is not always the best idea to do so. But as you can see here, when below the zero line, the MACD and the signal line can have a weak rally for a while before continuing to its downside. Therefore, this cross is important, but it's only one factor in determining the momentum of a stock. And the last and most important factor in determining momentum when using the MACD is spotting divergence. Unfortunately, there's no crystal ball indicator or strategy that can tell you the future momentum of a stock, but divergence has got to be the next best thing. It's probably one of the few, if not the only trading strategies that can show you future price movements, as the vast majority of trading tools are designed to show current and previous trends. So how does divergence work with the MACD? Paying attention to the higher highs, higher lows, lower lows, and higher lows of a stock ticker is just as important as paying attention to these on the MACD. When observing them together, you will often notice, for example, your oscillating indicator in this case the MACD, making higher lows while the ticker is starting to make lower lows. This divergence can signal to a trader to start looking for a trade in the other direction. So how does all this fit together? Well, a crossover of the MACD and the signal line determines a potential entry or sell signal and can be seen as either 1, a change in reversal, or 2, a temporary breather from the current momentum. So since a cross alone cannot determine which is true, more information is needed. Thus, where these lines cross helps further determine the overall momentum of the price action. If the MACD crosses over the signal line while above the zero line, the price is determined to be continuing in its uptrend. Divergence between the price action and the MACD indicator helps a trader determine the probability that the current momentum is changing and indicates to the trader that they should be looking to either enter or exit a trade. And of course, the histogram visually represents the difference between the MACD line and the signal line and is used to determine the strength and direction of the momentum. Throw that all together and boom, enjoy your island.